Hi everyone, my name is Eng Hui San, metro number 253550, and now I will talk about the global financial crisis and its effect on the growth in the Asian country. And the earlier financial crisis, which the Great Depression, is occurred in the 1920 until the end of the World War II. And then now today we will explain about the financial crisis which occurred in the 1997, the Asian financial crisis, and the 2008 financial crisis in the America. And I will use my poster to explain it more detail to yours. This is my poster and which I will present to you, and it includes the introductions, the cause and the effect of the financial crisis, and it has some current issue and the conclusion and reference, and will show to yours. Okay, let us start. First of all, we will discuss about the financial crisis which occurred in the 1997. According to the Fajran Safin's 2010, the Asian financial crisis is occurred beginning at the Thailand in the mid of the 1997, which will affect the neighbors countries to experience the significance of depreciation in those currency, and then the depress of the equity price, the suffering economies, and the dislocations of the financials. Okay, after that, according to the Chamuda Anjana 2017, the Thais have faced the depreciations of the currency, which is the baht, around the 20% in the years of 1997, and it also caused a serious reactions of the events to cause the country face the financial crisis. Well, the Thai baht depreciations, it will cause the stock market and the currency of the other country depreciations, and especially for the Asian country. So one of the example is in the Indonesia. During the times the Thai baht depreciations, the Indonesian rupiah also depreciation quick as well, and it also caused Indonesia face a huge loss in the companies and the banks. So let us watch a video, and this will be more detailed to explain the Asian financial crisis in the 1997.
The story of Asian financial crisis, so-called home income crisis, all began in Thailand after Thai government was forced to float the baht due to the lack of foreign reserves to support its currency pegged to the US dollar. Meanwhile, Thailand had acquired a burden of foreign debt that made the country efficiently bankrupt. Capital flee overnight, beginning an international chain reaction. Later, slumping currencies, devalued stock markets and other asset prices, and a precipitous rise in private debt were witnessed across Asian countries. Talking Thai, for example, domestically, this crisis could be attributed to several factors. Firstly, the entire debt structure of Thailand is unstable. Heavy foreign debt leads to higher risk of default. The currency later come to depreciate. Thai economy is vulnerable at its core, while externally, Thai economy exhibits a kind of fake prosper. Secondly, unbalanced economic structure of the country was the one that should be blamed. Malformed securities and real estate markets had shaken the base of the nation. Thirdly, Thai's export sector over-relied on agriculture and travel industry while being weak in manufacturing. This accounts for the vast oscillation of domestic economy and trade deficit. Therefore, slight changes happened in the international market could cast a massive impact on their economy. Last but not the least, crony capitalism, along with inadequate financial regulatory system, caused widespread bribe and risky investments across the nation, leaving the government and the market unable to cope with financial crisis.
After watching the video, we will more understand what about the Asian financial crisis in the 1997, and in overall it can allocated by the two causes, which is in the financial sector weakness and the problem in the external sectors. In the financial sector, which is have a large price of earning rate in the markets. It also have a foreign debt, which is borrowing in the foreign currency, and it also have the pool of the supervisions. And after that, the problem in the external sector, which is have a large current account of deficit, dependency on the export, unsound investments also will cause the financial crisis occur. Okay, after we explain about the Asian financial crisis in the 1997, so now I will explain about the financial crisis which is in the 2008. The financial crisis in the 2008 occurred because the subprime of the United States. According to the Reserve Bank of the Australia, in between 2007 and the earlier 2009, it will have a period which is extreme threat to the global financial markets and the bank systems. Have a turndown of the US housing market will affect the banks, cause them have a huge loss in their financial markets. According to the Mountain Mini 2009, the financial crisis will caused by the subprime house loans. The subprime means that it's not meet the standard criteria of the goods credit qualities for a person. So that means all of them, whatever you have a good financial or you have a financial problem, you also can borrow these loans. So that means is the subprime loans. So it will cause the subprime lending become very significant in the United States. After that, we will show one video and will explain more about the financial crisis in the 2018.
It all starts with this guy. This guy is Louis Ranieri. According to the movie The Big Short, this guy changed your life more than Michael Jordan, YouTube, and iPod put together. He was a bond trader at Salomon Brothers when he came up with the idea of mortgage-backed securities, or MBS. This is your average person's mortgage. When he needs to buy a house, he approaches the lender. The lender gives him the money to buy the house in the form of a loan. And the house owner pays back the lender principal plus interest in the form of monthly repayments. This is a basic single house mortgage contract. Now if the house owner defaults, that is he refuses to pay his monthly payment, the lender is at risk of not receiving his principal back. Now a big investment bank calls up the lender and buys up that contract. From the money received by the lender, it makes more loans to fund other house owners. Now if the house owner defaults on its monthly payments, the lender is not at the risk is transferred to the investment bank. Now the banks borrowed billions of dollars to purchase thousands of similar mortgage contracts and they bundled them all together into mortgage-backed securities. This was a simple, easy, but a brilliant idea, as even if few homeowners default, payments from other houses would make sure that the intrinsic value of this security or contract is preserved. Now, the experts at the investment bank converted the existing MBS to a complicated financial instrument known as collateral debt obligation, or the infamous CDO. CDO has layers, or tranches as they were called. The low return branch bearing low risk profile, the moderate return branch with moderate risk profile, and the high return branch with the high risk profile. These layers were then sold off to investors according to their risk profile. This was a win-win situation, as this gave investors an asset to invest their money to grow, and for the banks, which made huge sums of money in commission fees without bearing any risk, since now, if the house owners default, investors bore that risk. Now, banks were making billions by repackaging mortgages and selling them to investors for commission fees. But after a certain point, banks ran out of homes to put in those bonds, as after all, there were only so many houses belonging to people with good enough income to afford them. So banks started putting more and more risky loans in these MBS. These loans had shady characteristics like variable interest rates, zero down payment, and no income verification. These type of loans were called subprime loans. Banks themselves borrowed huge sums of money to buy these risky loans, thereby increasing their leverage. Leverage represents the amount of debt used to finance a firm's assets. The top 5 US investment banks increased their leverage rapidly from 2003 to 2007. By 2007, they were all at around 30x levels, meaning they had borrowed 30 times their working capital. As the number of risky loans went up, default rates increased. More and more people couldn't repay their mortgages. Initially, it wasn't a problem as house prices were doubling every few years, and hence the bank would recover the money by selling the homes that have been defaulted upon in the market. But as the default numbers skyrocketed through the roof, there were more and more houses in the market up to a point where supply exceeded the demand, and the house prices started plummeting. So initially, house prices increased at fast pace as anyone could get a loan and purchase it. But when the default numbers went through the roof, there were more and more houses to be sold in the market than the buyers, and the house prices started decreasing. They decreased rapidly. Now, as there were no monthly repayments, there was no money coming into the CDOs, and thus for the investors who purchased these CDOs, they stopped receiving any returns. Investors stopped buying these CDOs and its demand went to zero. Now, the banks who were heavily invested in these assets began to experience a liquidity crisis. That is, they had no one to sell these CDOs to. They were basically sitting on worthless asset which they couldn't sell. Now these financial institutions, already over-leveraged, were suddenly in huge debt as they can't repay their own loan used to make these risky investments. The over-leverage was kind of a ticking bomb, which finally exploded. In fact, the total debt of top 5 US investment banks was over $4.1 trillion. That is about 30% of US nominal GDP for 2007. These factors I've talked about is to get you know the gist of what happened during 2007 and 2008. Like incorrect pricing of risk by the banks, increasing complexity of financial instruments like synthetic CDOs and CDO squad, deregulation under Alan Greenspan, and easy credit conditions.
After watching the video, we will understand more about the financial crisis occurred in the 2008. And in the summary, we will know that they have some of the factors to cause the financial crisis occur. First of all is the subprime lendings, and second one is the housing bubble, which is appeared at the 2006. Also, it have easier credit conditions, which is have a low interest rate, and it also have the regulations of the bankings in the 1970s onwards, the government policies. So those factors will cause the financial crisis occurs. Okay, now I will talk about the financial crisis which occurred in the 1997 and the 2008, which bring the effect on the growth. So we will choose a certain Asian country in our studies, which include Malaysia, Singapore, Thailand, Indonesia, Philippines, Japan, South Korea, and Hong Kong. In the study, we will see about the effect on the GDP growth, the unemployment rates, the inflation rates, the capital investments, the foreigners direct investments, FDIs, and the export goods and services in those Asian countries. Okay, let us talk about the effect on the GDP growth. This is the table show the GDP growth for the Asian country, and I will use the line chart to explain it. We need to see more details. I will conduct it to the structure chart, which is like that. The structure chart shows that it has the significant decrease in the 1998 and also have a significant decrease in the 2009. So that means the GDP growth is very affected by the financial crisis. After that, I will talk about the effect on the unemployment rate, and this is the line chart. We will see that it has a slightly increase in the unemployment rate in the 1998 and have a slightly increase in the 2009. Besides, we will see about the inflation rates. This is the line chart, and after that, we will see that it has a domestic increase in the 1998, which is after the financial crisis 1997, and it has also have a slight increase in the 2008, which is in the financial crisis in the 2008. And after that, we'll see about the capital investments. This is the line chart. Based on the graph, they have a slight decrease in the 1998 and also have a slightly decrease in the between 2008 and the 2009. After that is the foreign direct investment FDI. This is line chart, and based on the chart we will saw that it have a decrease in the 1998. It also have a decrease in the 2008, which is after the financial crisis and in the financial crisis. After that, we will see about the export of the goods and services. Based on the graph, we will see that it have a domestic decrease in the 1998 and then also have a domestic decrease in the 2009. Okay, let us take some time to talk about the current issue in 2020. So the current issue, which is the coronavirus, which affect our health rights. So after that is not just affect our health, it also affect our financial sectors.
The impact on output, gross domestic product, in the developed countries will vary between minus 15% and minus 30%. The IMF is telling us is that we're going over an economic cliff right now. They're expecting that in the advanced countries, GDP will decline roughly by 12% between the end of last year and the second quarter of this year. Thereafter, they hope there will be a recovery. It will be a long time to get back to the starting point, but there will be a steady recovery. Unfortunately, even that could prove to be too optimistic.
And those countries also have a huge estimated the unemployment rates will increase, and the SME investments also will face the problem, which is the cash flow in their business. According to the study which I am doing, so they will see that it have a trend, which is the 10 years will have a once time occur the financial crisis. So that means our governments need to have a preparations for the policy and some improvements to overcome the financial crisis. And after that, our citizens also need to have some awareness for the financial crisis, and such as doing some savings and to help them can survive during the financial crisis occurs. So that's all for me. Thank you.